Quantitative easing.
Quantitative easing.
QE.
Quantitative easing.
Quantitative easing.
What is it, and what does it mean for the economy? Spoiler alert, not that much. A central bank has many different tools to serve its primary function of low and stable inflation. Tools that include but are not limited to controlling short-term interest rates, forward guidance, quantitative easing, control of the money supply, overseer of the financial system, the banks of banks, and lender of last resort. For this video, we will focus on these short-term interest rates, forward guidance, and quantitative easing with the ultimate aim of explaining the what, the why, and the how of quantitative easing. Key features of modern central banks in most of the developed world are a chair with a relatively conservative attitude on inflation, independence, and inflation targeting. These help the central bank maintain low and stable inflation by increasing accountability and limiting political capture and inflation bias. Inflation bias is the idea that improving growth or employment is seen as a worthwhile trade-off for increasing inflation to potentially unhealthy levels for the economy. Having a chair who has a more conservative view on inflation than the general public is a good thing because it helps them limit the amount of inflation they are willing to accept as they pursue their agenda. Independence is quite obvious to help limit political capture, and you might think inflation targeting is very self-explanatory, but we'll get into the true power of this policy when we discuss expectations and forward guidance.
It's not about money. It's about sending a message.
I think that forward guidance is the dark horse of monetary policy. As we pick up the pieces through the video, we'll see that actually the impact of QE after the first round of QE is quite questionable on growth and inflation. To understand the importance of expectations, we have to ask the question, what happens when an independent central bank still suffers from inflation bias, which for our intents and purposes carry the same negative connotations as political capture. In the pursuit of secondary policies such as growth and employment, we suffer unsustainably high inflation. Recognizing this, the public expects higher inflation. Higher inflation expectations result in higher actual or realized inflation because people take actions based on their expectations as soon as possible. For example, business owners expecting higher inflation will raise their prices in anticipation of general price increases across the economy. Once a critical mass of agents in the economy react like this based on their expectations, even if their expectations were wrong and expansionary policies were not implemented, prices increase in the economy and we achieve higher inflation. This works in the same way that the stock market prices in new information on companies almost immediately, even if the news is to do with impacts or events of the future. For example, when Apple announces their new, powerful, and very energy efficient ARM chips, markets don't wait until these chips are actually released and implemented in Mac devices. Markets expect lower costs for Apple and thus higher profitability in the future, and as a result, the price of Apple stock goes up immediately. So here's the rule of thumb. In the long run, expectations equal actual. This makes inflation targeting and a conservative chair quite a powerful combination because it helps to anchor the public's inflation expectations. This is important to avoid having runaway inflation due to animal spirits. As you can see with the graphic, if inflation is above the target, the public expects an action from the central bank to correct this. As a result, agents in the economy also behave in such a way that will reduce inflation because of this expectation. Vice versa if we experience inflation below the target. Therefore, even if there are short-term deviations from the target, in the long run, inflation is equal to the target. If we look at average inflation, i.e. expected inflation in the long run, then we see it should be roughly equal to that inflation target. Forward guidance is more of the same in terms of anchoring expectations. For example, Mario Draghi and the ECB have been very communicative and almost always expressed expansionary sentiment for the foreseeable future. Draghi was famous for saying the ECB will do whatever it takes to guide the EU out of crisis. Whilst it sounds very simple, it is very effective. And interestingly, in financial markets, given how agents are so tuned into announcements, announcing asset purchase programs has an immediate effect on prices, whereas the actual purchases don't have a statistically significant effect. This implies that by the time the asset purchases are actually taking place, the market has already priced them in to the financial markets. When every agent is very tuned in, the long run will happen immediately. Expectations lead to the actual outcome instantly. So expectations and forward guidance is very powerful. However, the ECB has missed their target of almost 2% inflation consistently now. So now the concern is whether or not this new state of affairs has become anchored as the permanent state of affairs in agents' minds. If so, the ECB may struggle to break out of this and achieve their desired level of inflation for a very, very long time.
Go buy your mama a house. Go buy your whole family houses. Put this money in your savings account.
Short-term interest rates are the base rates you hear so much about. These directly affect the interest rates charged on all of your borrowing and savings. For a very long time, these little guys were the rock stars of central banking. Since the advent of quantitative easing, in most economies, central banks provide basically unlimited reserves for commercial banks. This happens under the floor system. Under the floor system, short-term interest rates are the interest rates commercial banks receive for keeping deposits with the central bank. Banks can borrow money from each other, but because of opportunity cost, banks would never lend to each other below this interest rate via the interbank lending system. If the rate of interest on the loan they provide to other banks is actually below this nominal interest rate set by the central bank, then they would rather always deposit reserves at the central bank rather than lend. This is possible because they have unlimited reserve provision thanks to the floor system. Therefore, the central bank can exercise near total control over the interbank lending rate and the country's unit of account. This does erode the market for interbank lending, but the merits of that market are outside the scope of this video. Given that it is commercial banks which provide a lot of liquidity and borrowing in the economy, by controlling the cost of borrowing for commercial banks, the central bank forces all interest rates across the economy to imitate the base rate. However, given frictions in the economy such as default risk in the economy, as well as the need to make profits off of spreads, there is some deviation from the central bank base rate. In this context, a spread is the difference between the interest rate charged to borrowers and that charged to savers. The one fundamental limitation to interest rates is the effective lower bound of the short-term rates. Currently, this is believed to be roughly between -1% and 0%. No developed economy's central bank has ever actually gone as far down as -1%. But the Swiss, European, and Japanese central bank have been in bed with negative rates for significant amounts of time. Anything below 0% essentially means you are taxing savings. As a result, savers withdraw all of their money as the return on cash, 0%, will be higher. This is one of the reasons why the ECB is so panicked about not achieving desired inflation. If a country experiences deflation, monetary policy and interest rates can lose effectiveness because of the effective lower bound. Now let's talk about long-term interest rates, which will lead us nicely to quantitative easing.
The ECB is ready to do whatever it takes to preserve the euro.
Picture the following yield curve as the general form of yield curves, upwards sloping. Why? Because lending money carries risk. The longer your money is in the borrower's hand until they are obliged to pay you back, the greater the risk for you. You can't predict inflation in 10, 20, 50 years as well as you can predict inflation 1 month from now. And in that time, who knows what else can change? So all else equal, if we have one bond maturing in 50 years versus one maturing 3 months from now, the one maturing in 50 years should carry a higher coupon rate, all else equal. However, agents also understand that the central bank controls all short-term interest rates ever. So, by controlling the path of all short-term interest rates, the central bank can also influence long-term expectations and long-term interest rates. This is the unbiased expectations theory, whereby following from the idea that the path of future interest rates is a combination of short-term rates, investors expect future interest rates to increase. Again, another reason why the yield curve is upward sloping. Combined with forward guidance, this control becomes more explicit, and it is something the ECB relies heavily upon to combat liftoff of interest rate expectations in the market. As expansionary effects take hold, markets might expect interest rates to rise. So by announcing that nominal interest rates won't increase for a very long time, the central bank ensures people's expectations don't move real interest rates observed in markets. Therefore, central banks lowering interest rates shift the entire curve down, bringing with it lower long-term rates, especially when combined with forward guidance. Now we're at the meat and bones of today's central banks. Quantitative easing is the practice of buying long-term or duration assets in order to push down long-term interest rates by a greater amount than short-term rates and consequently flatten the curve. Although by targeting different maturity bonds in the open market, central banks can target different parts of the curve. I won't go into bond maths as ideas like discounting will take too much time here, but just know that prices and interest rates on bonds are inversely correlated. This means higher prices, such as when central banks buy bonds and push their prices higher, cause the interest rates to fall. This makes sense because the greater the demand for bonds, the less the borrower can pay out in interest. This is the same way that the US can offer lower coupon rates for borrowing than a country like Turkey, or basically any other country in the world. And also why borrowing on the open market using bonds can be cheaper than just going to one bank and taking out one giant loan. Much more demand for that debt globally. Why is this necessary? Previously, changing interest rates shifted the entire curve up or down, but given the additional premium on long-term rates, short-term rates would reach the effective lower bound, but long-term rates would still be too high given the uncertainty and risk following the global financial crisis and the Eurozone sovereign debt crisis. Longer-term interest rates are more important for investment activity because investment activity takes time and has risk associated with it. So, quantitative easing has given central banks direct and explicit control over the full length of the yield curve. This is considered unconventional monetary policy, and it has led to modern central banks' balance sheets exploding. As you can see from the visuals, buying so many assets has led to their asset side exploding, but on the other hand, issuing so many reserves has led to their liabilities also exploding. Interestingly, given they are generally buying longer term assets with higher interest rates, and on the other side paying out low interest rates on commercial banks' reserves, this is proving to be rather profitable. These long-term assets are purchased mainly from commercial banks and financial firms who happen to own a lot of government bonds. In purchasing these assets, the money supply in the economy increases because these assets are essentially liquidated for the banks by the central bank. Now the banks can make loans for all sorts of activity in the economy, which should increase investment, employment, consumption, inflation, and all of that good stuff. But also recall long-term interest rates, which is what investment decisions are mainly based on, have also decreased. So there are quite a lot of positive effects here working on investment. Easy, right? Maybe. You see, quantitative easing drives up asset prices, and it is hoped that positive wealth effects can drive real activity in the economy. It's unquestionable that the desired effects on financial conditions have been achieved, but the same can't be said for an effect on real activity. Recall the power of inflation expectations in realizing actual inflation, and observe the inflation data in the US from the Fed's 4 waves of QE in response to the global financial crisis. We see that the only time QE had an impact on inflation is the very first announcement of QE and never again after that, except in QE3, but that was actually a bad impact somehow. These are density functions, so think of stuff like normal distribution curves you might be used to seeing. Here, we see the 5-year ahead's tails become thinner for QE1, especially on the side where agents expected deflation. This is very good because it means the first round of QE was effective at increasing inflation expectations. 1-0 quantitative easing. However, thereafter, we did not observe the same effect. This is because upon the first wave of quantitative easing, central banks had automatically moved to the floor system of reserves. Under this system, QE doesn't really impact inflation anymore. Only nominal interest rates do. So despite what media coverage might make you think, it's actually not quantitative easing that tends to have an impact on real activity and inflation anymore. Think about it. If we go back to the floor system graph I showed you, more quantitative easing just increases the Fed's supply of the reserves more and more to the right. But the market for these reserves is already satiated. The commercial banks have more reserves than they actually need right now. So the impact of more QE on the everyday man is actually not that much anymore. These days, it's only the interest rate the central bank charges on those reserves, that nominal interest rate, and the forward guidance they offer markets that affect inflation expectations. Just like that one friend who says they can always stop smoking weed whenever they want, but inevitably never stop, a lot of central banks have been meaning to taper off, but have actually increased the size of their asset purchase programs. For example, the end of Mario Draghi's tenure at the ECB was expected to mark the end of quantitative easing by the ECB. But since the coronavirus pandemic, it seems Christine Lagarde's legacy will be defined by the same old, same old. If you enjoyed this video, do smash that like button, burst it into oblivion to show your support, and do the same thing with the subscribe button. In my opinion, inflation is something that's massively overlooked by both the public and the media. God, I love bashing the media. So if you'd like to see that or anything else on this channel, do put your comments and suggestions in the comments section. As always, thank you for watching and stay safe out there.